Good evening, everyone, and welcome. Today in the evening, 7 to 8 p.m. Today, again, we are live with another webinar. And I say another webinar because this is the month where each trading day we are going to conduct one session, one webinar on a topic which is important to the investors. First day we did on financial literacy. It was for beginners, for people who have um, not planned their investments or want to know more about how investments work and what are the key terms and what are the key investments which they can implement in their lives. Yesterday we did a session on investors psychology, understanding about that how a mindset of a trader or an investor works, and when we are taking investment decisions, how each of these emotions become really really important for us to manage. We talked about that how sometimes a successful trader becomes really overconfident and does not calculate the risk the way they used to, and there were so many biases we discussed yesterday. You can definitely go on our YouTube channel and look at the previous sessions which were recorded, and every single session we are going to do this month, the recording of those sessions will be put on YouTube the very next day, and you can always revisit this. These webinars are powered to you by Century Financial. We are an investment consultancy. We've been here for last 35 years, and we have the expertise to bring some sort of research and awareness for our investors, and that is what we have achieved. And so far as we continue to move towards the market and towards special events and important economic events which are about to happen, it becomes our duty to sort of keep doing these sessions so that investors can be updated and informed. So welcome to all of you, and today we are going to discuss about something very important: market neutral strategies for you. Market neutral strategies. Guys, before I even proceed, um, let's understand also one more thing, that we need to definitely understand that what is the importance of these strategies. We also have to see, and we also have to learn about how important it becomes to manage our risk. So just try to, first of all, I'm sure you will have a lot of questions. So try to use your chat options, right? So that use your chat option to, if you can see my presentation, if you can hear me, if you have any questions, please do use your chat options and try it out, test it out. Just write yes or okay, and I will get to know that you have, and you're able to see me, you're able to hear me properly. Just try it out. Because it's really important that you should be able to see uh, the presentation, and you should be able to see everything what we are doing over here. Try it out, guys. Try it out. Try out your chat options so I can proceed further. If you have any questions, if you want to say something, use the Q&A part. Maybe the Q&A part helps you to understand that how it works. Just write, try to write the Q&A. Okay, because I have a few viewers over here. I have a lot of attendees over here. I can see. Just try it out, guys. Just try if you can use your chat options or not. Just want to make sure that it is enabled. So if you have any questions, it can be asked. Okay, I think it was disabled, and now it should be enabled. Perfect, perfect. Yeah, that's great. Perfect. So I've started getting questions. Perfect, great. So guys, you can use this platform to ask any questions also, and if you are not able to understand, definitely you can do it. So I think now the chat was not enabled before. Now it is enabled. Perfect. So, market neutral strategies. We are going to talk about a few ideas. We are going to discuss a few information. Please let me know if you are able to understand this or not, and we'll try to make sure the best explanation can be given. And any strategies we are going to discuss over here, before you implement it on your live account, uh, please talk to the consultants first. The information I'm giving to you is for understanding purposes. If you have any doubts, if you want to execute these strategies, do consult your risk experts or do consult an investment expert before you put this in your live accounts. Now, before we move on to market neutral understanding, we need to have one clarity about what is short selling, right? Short selling is something which is really important because short selling is one of those important concepts where this is the foundation of market neutral. And I will come to what market neutrality is also, and I will highlight the importance of. But first and foremost, we have to understand how short selling works in investments area. Short selling is the process by which, if you anticipate that the price of something is going to come down, it's going to fall, you can take advantage and make money, right? Once again, short selling is the process by which you can take advantage of the falling prices in your favor. And how does that works? It's very simple, very simple. And I'll even use the live platform to give you an explanation over it. And please let me know if you've understood it right or not. There is the market, then there is you, and then there is a product, right? So for example, let's take an example of Nvidia. Let's say, for example, for some reason you feel that Nvidia has already reached to a higher point, and now from there it might come down due to any reason, due to poor earnings, due to lack of demand of AI, due to any reason. If you're feeling that Nvidia stocks are going to fall, what do? You reach out to the buyers who have already bought the stock, and you borrow that stock from the buyers and you sell it in the market at the current market price. And when the price drops down to your desired level, you can buy it back at a cheaper price and give it back to the person you borrowed the stock from. This is called short selling. So in this diagram, the chart which you see right now, or the image which you see right now, let me take you through. See the first bit, which is your broker. Consider this broker as the person who already is a buyer of the stock, right? Let's here I have given example of Microsoft. So we'll take example of Microsoft here. Let's say there is a broker who already has Microsoft shares, who has already bought Microsoft shares, right? Broker or buyer, you can whichever explanation is easier for you. Let's say, for example, if there is a buyer who is already holding Microsoft shares, and you feel that the Microsoft stock is going to fall down, what you can do is you can reach out to that broker or the buyer and you can borrow Microsoft shares. And once you borrow, you sell them in the market. So let's say if the price for Microsoft share was $300 per share, you borrowed it from the buyer and sold 10 shares of Microsoft for $300, right? Now you have sold the share, you have the money, but the transaction is not complete because you have to give these shares back to the broker or to the buyer. Now, once you have sold these shares, the price starts coming down as you anticipated. And from 300, it goes down to 200. What do? Because you sold at 300, now the price is 200. So you use that $300 which you got once you sold those shares, use 200 to buy it back. So 100 is your profit. And you buy these shares and give it back to the buyer. And this is exactly how a short selling process works. Now, the good part is you can short sell gold, silver, crude oil, natural gas. You can short sell a whole US stock market index or a European stock market index. You can short sell literally everything you feel that the price of which is expected to come down. And this is really important. Why? Because markets do not move in an upward slope all the time. There are times when markets come down, when prices drop, and this is applicable for everything, whether it is gold or silver or platinum or palladium or crude oil, anything. This is applicable to everything. The prices do not just move in one direction, they come down. That is the reason why a lot of people do online trading, because for them there's an opportunity to take advantage of the prices when they're going up, but also when the prices are coming down, there's an advantage which they can take. Now, what I'm going to do is I'm going to show you a live example using a live trading platform, that how the short selling happens. Please focus over here. The purpose of this practice is not going to be understanding that whether your trade is going to be in a profit or loss. I'm just going to tell you that how the transaction works, and we are not doing any research before placing this trade. I'm just going to pick one instrument and just sort of anticipate that the price is going to come down, right? We are going to assume that price is going to come down, so I'm going to short sell this. Now let me take you to the live screen, and please continue to ask. If you have any questions, please use the chat option, use the Q&A option to ask any questions if you have. Let me share my live platform right now. Perfect. Okay. So let's say, let me just edit this. Now here, what you see is a bunch of products put together, right? There is currencies, which is in a form of euro dollar. There is a US stock market index, which is S&P 500. There is small cap index, which basically gives you an average performance of the smaller market value companies. So you can invest in that also. There's German index, Hong Kong index, UK, US, and a lot of these. Gold, for example, we have gold as well. Now let's say today oil has fallen down a lot. And if we are anticipating that the price of oil is going to fall down further, right, or the price of gold is going to fall down further, what we need to do? So let's start with gold, for example. Gold currently is $2,496 per ounce. Since we are talking about gold, gold is one of the most volatile instrument. It's one of those instruments which moves a lot, at least $20-25 a day very easily. And while I speak about this, today's low for gold is 2471, highest is 2500. So already $25 to $30 movement has happened. Now let's say right now it's very close to today's high. You feel that from here the prices might drop. All you need to do is select sell in your live trading account and put the amount of gold which you want to sell. Now the first question should arise in your mind, that how can I sell something which I don't have right now? You are borrowing this from the broker's inventory. Every broker has an inventory and they have products with them. So whether it is a stock, whether it is gold, whether it is oil, or there are a lot of buyers which are with the broker, and you can get access to these buyers and you can borrow these products from them and you can sell it in the market. So when you click sell, you are basically identifying a buyer and selling 100 ounces of gold from that buyer, right? And you have to give this back to the buyer, right? So when the price drops, you'll be able to buy it back at a cheaper price and give it back to the buyer. So when you select sell, you click confirm, place your order. Now it shows that you sold gold. You go to your account, go to your positions just to see the trade. Let me close the one which is in profit. Yeah. Here, if you see, you have selected sell, right? You have sold gold at 24.94. Now the buying price is 24.96. If the price drops below 24.94, which means you will have the opportunity to buy it at a cheaper price. So while you have sold it at a higher price, you can buy it at a cheaper price, and whatever is the difference you can keep, and the remaining difference goes back, and the commodity, for example, goes back to the buyer or goes back to the broker. Guys, this is an opposite of buying low and selling high, which means if you feel that markets have peaked, so I'll show you a graphical representation of what I just told you. Let's say you're here right now, exactly at this point, and you feel from here the markets might come down here. So you can borrow gold from a buyer and sell it here. And once the price drops here, buy it back at a cheaper price, keep that price difference with you, which is your profit, and you give back the commodity to the person you borrowed from. So this is how short selling works. And it's really important to understand short selling when we are talking about market neutrality at all. This is the reason how why a lot of people use online platforms, use leveraged accounts to do it, because you cannot short sell if you do not have a margin trading account. So short selling requires margin trading. There's a question here, uh, by when time frame should the short sell be squared off? So this is a very important question. In a lot of so basically in India, the if you have done a short selling transaction, normally by the end of the day you must give back the commodity which you have borrowed from the buyer. But here, as long as you have the money in the account and you want to hold on to it, you can. So there is no time limit that by the end of the day you must return this back. You can wait days, weeks, and months till you make a profit. And if you have the holding capacity of the trade, you can definitely do it for as long as you want to. So there is no restriction that by the end of the day you must square off your position. Right? When I say square off, that means book a profit or loss. So there is no such compulsion. Right? I'm sure a lot of you must be thinking that why I'm explaining short selling to you. And that being said, if anyone has not understood short selling, we can definitely have a one-on-one session where I can show you another live demonstration of how the short selling works. For now, just understand this thing, that if you feel that the price of something is going to come down, you can borrow that product from the market, sell it to somebody who wants to buy, and once the price comes down, buy it back at a cheaper price, and the price difference is your profit, and you give back that product to the person you borrowed from. That's exactly how short selling works. There's another question over here, that if I short sell something, can I hold on to it for more than a day? Yes. So in case if you want to roll over that position or roll over that trade to the next day, you can. So that is something which is possible and definitely can be done in the financial markets. Now, why it's really, really important? Because our market neutral strategies are based on market neutral. What does neutral means? Neutral means sort of trying to balance or neutralize the impact of something. So if I buy something, I short sell. These are two important parts: long and short. When I say that let's get long on Apple, what does it mean while we are on the live platform? Let's say I want to go long on Nvidia. Going long on Nvidia means I want to buy Nvidia shares. 100 shares of Nvidia, press enter. I want to buy. I'm buying. I'm going long on Nvidia. So I confirm, I place my order long on Nvidia. I want to go short on crude oil. Short on crude oil. What does it mean when I say I want to go short on crude oil Brent? Which means I want to sell oil. I want to borrow oil from somewhere and sell it in the market. And if the price comes down, want to buy it back at a cheaper price and give back oil from where I borrowed from. I'm expecting oil prices are going to come down. So I'm going to short sell 1,000 barrels of oil. This is the difference between long and short. I'm buying one, I'm short selling another. Buying one, short selling another. Now, how market neutral fits in all of this? Let's get back to the slides, and please continue to ask if you have any questions. Uh, there's a question: in short selling, margin required will be more compared to the buying. Not really. Lot of so will have a complete different session on margin trading and understanding that how markets work. But since there is a question which has been asked, that if you're short selling, does the margin require is more? Not really. More or less, it's the same. So if it is 1% required for the buying, it's mostly 1% required for the selling also. Correct. So now once we have understood how short selling works, before again I move on, just a one word understanding. If you're expecting that the price of something will come down or a price of a stock will fall, short selling is a process by which you can make money and make a profit if the stock falls. How can you do it? Using a short selling process, right? If I say you are going short on a stock, you're going long on a stock. If you're going long on a stock, which means you are buying, you're expecting price will go up. You want to make a profit if the price goes up. When you're shorting something, which means you're expecting price is going to come down. So you want to make money once the price comes down. Again, as I said, if you have any queries and questions, please continue to write and I'll try to make this concept much more clearer to you. Moving on to the main idea, which is market neutral investing. How market neutral investing works. Look at this chart. Don't think about anything else. Just hear what I am telling to you right now. This is obviously not a concept which can be understood in one session, and me, trust me, I'm using the terms which are necessary for you to know. Market neutral is something which you must know. So if you feel that at any point of time it is becoming complicated to you, you can send me a message and I'll try to simplify it more. But at this point of time, it's important that you must get introduced to this terminology, right? Just look at this chart, what I'm telling you. On the first side where it says long opportunity set, here you are trying to make money when the market goes up, right? So what you're trying to do is, most of the investors, they focus on those stocks which are going to go up, right? How many of you always think about, oh, what should I buy? The value of this can go higher, so I should buy this, right? So this is your focus. Nobody has ever thought, let's try to make money from something which is falling down, right? Because you never knew about short selling, but now you understand that there are so many horizons how you can actually invest. So the first bit is the most natural bit. Long opportunity side. Long opportunity means you want to buy those stocks, those commodities, those currencies, those cryptocurrencies, those indices, those markets, those products which you feel are going to go up, so you can make money from there. But do you know that you're missing out on the other leg, which is called short selling? So you can actually make money when the markets are also coming down. So now there are multiple horizons. There are two horizons now. You can take advantage of the moving prices and the prices come down. This is what market neutral investing is about. Buying and short selling. The product which you feel is undervalued, you buy, so it goes up. The product which you feel is overvalued, you short sell because you're expecting it will come down. If it comes down, you're going to make money. If it goes up, you're going to make money. So these are two different products. Now, these two products can be very much correlated to each other in a positive manner or in a negative manner. How do I how what example can I give of a positive correlation? Can anybody tell me what name comes to your mind of a related company, right? So you will know what I mean to say. When I say Pepsi, which is the next immediate relatable company comes to your mind? Exactly the same. Very close. When I say Pepsi, what are you thinking? Which other same very related beverage company comes to your mind? Write it down. Write it down. It will help you to understand what I'm trying to explain it to you. Write it down. When I say Pepsi, which is the next company immediately comes to your mind, which is very close to Pepsi? Right? Okay. And I'm sure a lot of people have started replying on this. Guys, try to reply. Think about it. When I say Pepsi, What comes to your mind next? Think about it. Think about it. Okay. I think a lot of you have given exactly the right answer. Coca-Cola. When I say Pepsi, the first thing comes into your mind is Coca-Cola. Now try this out. When I say MasterCard, which is the next immediate company which comes to your mind? So you will understand that how closely these brands are connected to each other because they have the same target market. They face the same regulations. They have the same product. Which is the next immediate company is coming to your mind when I say MasterCard? Use your chat options, guys. Use your chat options. Try to get engaged into it. See, my job is to be here till 7 to 8 and make the best out of this time. And I will try every single bit to make sure that you understand these concepts and even give you a post event opportunity to connect with me one on one so that I can explain you further. But if you get more involved into it, it is really going to help you out. So I got one answer, Visa. I got one more answer, American Express, right? So basically, you understand that these are very connected brands put together. MasterCard, Visa, Pepsi, Coca-Cola. So many brands like this which are very closely connected. Now, benefits of market neutral trading before I move on to what I want to show it to you. Market neutral strategies are the one where we take advantage of the companies which are going to go up and the companies which are expected to come down, right? So I buy the one which are expected to go up, I short sell the one which are expected to come down. But there's one condition. The condition is that the two products need to be related in a manner where the correlation is positive or negative. So if I talk about Pepsi and Coca-Cola, if the stock price of Pepsi goes up under normal circumstances, nothing changes, normal, usual world, we expect the price of Coca-Cola is also going to go up, right? So these two products are positively correlated. But if I talk about a negative correlation, what is a negative correlation? Negative correlation is when the price of one product goes up and other product comes down. That's a negative correlation, right? This is what it looks like. One is going up, another is coming down, right? So this is a negative correlation. So we need two products which are either positively correlated or very negatively correlated. There has to be some sort of correlation, right? So either they need to be, uh, say, two friends who go very well together, or probably not the right example, but let's say a husband and wife. So whenever you get into a fight, one goes in this direction, another goes in this direction, right? So this is how normally a market neutrality works. When you're expecting that both these products who move in similar direction, and you anticipate that due to some reason one of them is going to come down while other continues to increase. So you buy one, you short sell another. We'll take example of this. What are the benefits? Benefits is that when you do a market neutral strategy, your focus is on those products, not in the overall market. So if I'm talking about Pepsi and Coca-Cola, I'm only focused on how Pepsi and Coca-Cola are going to react together. If I buy one and short sell another, I'm more focused on the relationship between Pepsi and Coca-Cola, right? I'm more focused on that, oh, Pepsi should go up and Coca-Cola should come down. I don't really care about how US as a whole performs. So it has minimized the overall market risk, but it is more concentrated on a specific product risk, right? So this is one part. Benefit is it minimizes the market risk. Now, there are few things which are important. Uh, it is an important form of risk management. I'm sure a lot of you focus on uh, long-term investing, buy and hold. Some of you also do regular trading, speculative trades, right? For effective risk management, buying and shorting, market neutrality is really important. Okay. Uh, of course, there are a lot of such strategies which can be used. There are a lot of hedge fund managers who uses market neutral strategy and pair trades to outperform the market, and you can do this too. This is the best part. We feel that this what hedge funds do, we cannot do. But let's understand that how easy it is. I mean, it's not too easy because you need a lot of data, but that's where we step into the picture. We are able to provide you these kind of information and research, and you can try basically to work with us, and we'll be able to give you some of these strategies very easily. One of the important market neutral strategy is pair trading, right? This is the most important one. This is also called sometimes statistical arbitrage as well. And the pair trading, as the name suggests, you need a pair, you need two products. Now, those two products can be connected to each other in a very positive way, like Pepsi and Coke, MasterCard and Visa, because they both would move in the same direction, or they could be uh, opposite to each other for some reason. Let's say that if let's take example of two economies. Let's talk about US economy and let's talk about Venezuelan economy. While US economy continues to prosper, Venezuelan economy continues to come down, right? So two very opposite, very different uh, economies, two very different stock markets. Or let's take example of two asset classes: necessity versus luxury. What happens when recession comes? You, as an average investor, would be more inclined towards buying necessity stocks. Necessity stocks means coal, power, electricity, transport, instead of buying luxury stocks. Because when there is recession, you may not want to buy an iPhone, right? But you definitely need to pay your electricity bill. So you choose consumer utility over consumer luxury, right? So these are two segments that if there's recession, one is going to move higher, another is going to come down. So we find out these kind of pairs and we try to buy the one which we feel is undervalued and is expected to go up, and we short sell the one which is expected to come down. There could be different reasons. So what is the process? First, you identify the pair. I identify Pepsi and Coca-Cola, right? Evaluate the spread. What is the spread? Spread is the difference. The difference. Now, this difference can be anything. Difference is the gap at which these prices move. So, let's say historically we have seen that the average price difference between Pepsi and Coca Cola is this much, and they continue to move in a similar direction. Now, sometimes this gap might increase, sometimes this gap might reduce. So, we have to evaluate the spread of this gap. Will again, as I said, guys, this is not the only session about pair trading. Uh, this is mostly an introduction in the world of market neutrality. If you need to implement a trade, you definitely need to sit with us and understand that how these strategies work. So I'm just trying to make the best use of this time and trying to explain it to you that how these kind of strategies work, and then we'll try to take an example and put it in the live trade also, right? And I'm going to show you one of the easiest way to do this. So you evaluate the difference and then determine the entry point, the price at which you want to take this strategy, the price exactly where you need to buy and short sell. And similarly, you have to plan your exits. Now, we'll talk more about this in the coming session once we discuss a few strategies together. Let me emphasize on this particular chart. Right now, what you see, the slightly darker blue line is the price performance of Coca-Cola versus slightly less blue, which is Pepsi. Okay, this is the correlation between Pepsi and Coca-Cola. These two are very similar companies, right? They have the same target market, they follow the same almost the same product, they face the same regulation. Can I say that in either way, Pepsi or Coca-Cola, either one of the companies are getting any advantage, any specific advantage? No. They have the same challenges, they have the same advantages or disadvantages. Both of them are bigger names. So if you see, the stock price also tends to move in the similar direction, right? Look at this chart. This is uh, from So this has been taken from 2019 till 2021. And if you see 2019 to 2021, right, almost 2 years. For 2 years, if you see how closely connected Pepsi and Coca-Cola are, the price movement is also, like, if you see the correlation, it is moving in a similar direction. Both of them. See the big fall which happened in 2020. You can see this big fall. So Pepsi also fell down, Coca-Cola also fell down. And then when the recovery happened, both of them recovered similar. But you must have identified that while I'm showing you this chart, there are these bigger gaps somewhere, and somewhere the gaps are smaller. Then again, the gaps get bigger, and then again, the gaps get smaller. This is where the entry exit of the pair trades happen. This is really important, guys, because imagine that how close the prices of Pepsi and Coke were moving, right? Like this. But then a slight deviation happened where probably Pepsi went up slightly higher and Coca Cola did not move much. And that opened a room of opportunity where you can short sell Pepsi and bought Coca Cola, because either this will come down and close the gap or this will go up and close the gap. And this is what has happened. So if you see in 2020, from March till September, the price gap kind of increased between Pepsi and Coca Cola. Pepsi slightly went up, Coca Cola stayed particularly around the same level. And then after September, that gap sort of closed. What happened? Coca Cola bounced back, Pepsi came down, and this gap again became so close. Look at the end of this chart. Imagine if you had short sell Pepsi and bought Coke that time, you have sort of created a arbitrage window, because both these are similar products, they move together, but there was a slight gap in this where you entered, and the moment this gap started shrinking, you exited, right? This is exactly how a market neutral strategy works. You make money both ways, but this is not always the case. This gap which has opened like this, it might become bigger, right? So there are risks into this. None, please make understand this, this is not a risk free strategy. Okay, there are risks involved into it, but this is a different strategy from, normally a lot of investors are not really aware about this, because for them it's too complicated. But the point is, that's why you need investment consultants, guys, because we are living in a world where one strategy is not going to work. Just buy and hold is not going to work. Just speculative trading is not going to work. You have to keep trying and trying and trying and put new ideas into the perspective. We are living in a world of AI, right? So we need to find out that how we can exploit different investment opportunities and try to put them in our portfolio in a manner where risk is also managed, right? So this is one of those ideas, that how you can use short sell in market neutrality and try to reduce your risk. Because when I was talking about Pepsi and Coca Cola, did I talk about overall stock market at all? No. I did not talk about what happens to the rest of the world. Wars happen, pandemics happen, tsunamis can happen. I'm not worried about it or for my portfolio, because my focus is to make sure that this gap which is between Pepsi and Coca-Cola, this gap should come closer and I can make an exit and get out and make profit out of it. So my market specific risk reduced to stock specific risk. This is the benefit of market neutrality. That is why you put this in your portfolio, because now you're not worried about what will happen in US. You're only worried about two products, that will Pepsi and Coca-Cola, will Pepsi outperform Coca-Cola or will Coca-Cola outperform Pepsi? This is what you are worried about, security specific. So this has a lot of benefits, because first thing, you can diversify this in a form of a strategy, right? So you have your fixed coupon bonds, you have your fixed income stocks which gives you dividend, you have your tech companies which you have bought, then you do your speculative trades, then you do long term buy and hold, right? Some commodities which you have purchased, some mutual funds, ETFs, and now you can trade in these pairs also, which is market neutrality. And this is not only restricted to stocks, ladies and gentlemen, this can move to indices, this can move to commodities also, right? So we are going to take all these examples together. As I said, guys, if you have any trouble understanding this, and if you need, definitely, I'm sure you will require more sessions. I am available one on one to explain you these strategies. Come to our office or arrange a call, and I'll be more than happy to do it. To show you one more such example, I gave you one example between Pepsi and Coca-Cola, right? Now I'm going to give you example between two commodities. There are two kinds of crude oil. One is called Brent crude oil. One is called WTI. There are two kinds of crude oil which is traded. I'm also going to show this to you. My screen is live right now. I hope everybody can see this. So see, while we speak about, just to give you an idea, see how you can take advantage of short selling. Now, see, you're seeing a small green over here. That's your profit. Why? Because you short sell gold at 24.94, but your buying price is 24.94.3. So you short sell it at 24.92 and you bought it at 24.94.88. So you see how close it becomes if the price starts falling down. Take example of Brent oil, for example. You short sell it at 74.1. The buying price is 74.03. It has come down by 7 cents. So your profit is $74 right now. Again, the the point of doing this transaction was not to show you the profit or loss, just to give you an idea that how short selling works. Right now you are making money in oil even when the oil price is coming down. This is called short selling, right? So if you want to close this trade, for example, book the profit, expand this window, click on red cross, close. Now you're buying the oil back, but the moment you bought it back, it went back to the person you borrowed from. You don't have to buy and keep it in your portfolio. That's how short selling works. Now coming back, I said there are two kinds of oil. So where is crude oil Brent? This comes from the North Sea, right? Russia, Saudi, uh, the Middle East is concerned with Brent oil. And then there is crude oil West Texas, which comes from the oil rigs in US, right? Notice the price difference. The Brent price is 74 point. Both of these oil are traded. And if you see the percentage decline, guys, Brent has come down by 0.35% today. WTI is down by 0.38% today. See how close their decline percentages are. One is the Brent oil, other is, so one is the European, one is US. But you see the percentage decline is so close, it's pretty much the same. Let's notice the price difference between both. Notice this price difference. The Brent is 74.13, WTI is 70.74. To give you the exact price difference here, 74.13, 70.74, $3.39. This is the approximate price difference as we speak, $3.39. Okay, please remember $3.39. Write it down, the price difference between Brent and WTI. I'm going to give you a minute to write it down on a notepad. The price difference, if you have a notepad, I have mine. I'm going to write it down over here. The price difference between, and say it out loud wherever you are, so you will be able to remember this, that the price difference between Brent and WTI, I'm still a very old school person. I like writing on a notepad. That's maximum retention. Difference between Brent and WTI crude oil is $3.39. This is the price difference. I wrote it my own. Might look inverted. So write this down wherever you are. Repeat it in your mind. Remember this. Every single day, remember what you saw. Price difference between Brent and WTI, $3.39. Now, I come back to the screen. The difference between the Brent and WTI is also called Brent WTI spread. Okay. Again, I'll keep reminding you, WTI is US oil, Brent is the European oil. So Brent and WTI price difference is also called Brent WTI spread. The chart which shows this price difference, that how this price difference has moved, it is called Brent WTI spread chart. Now, right now, as we speak, so there is a spot commodity, there is a future commodity. This was taken, I think, on August 23rd. The price difference was 4.5. right? This was updated last. Today, it is 4th September, so 10 days. Currently, the difference is 3.39. The chart which you see, this is of 1 year, right? Last 1 year, if you see, the price difference has gone above 5 also, which is around $6, and it has come down as low as 1 as well, and currently it is around 3. So the price difference between these two oils is $3, while it used to be 6, and it also used to be 1, and currently it's 3. Now, the point is that if you feel and if you anticipate that the price difference between these two oils is going to increase, what do you need to do? The one which is expensive, you buy, because either this will go up or this will come down. But either way, if you're expecting that the spreads will increase, the price difference from 3.39, if it will become 5, it will go back to the level it was, then you need to buy the Brent and you need to short sell WTI. What will happen? In this case, what will happen? Uh, Look at my screen. Right now, both these oils, they move in a similar direction. Even the percentage decline is so similar, right? So if you buy Brent oil, and let's take this trade right now, actually, let's say the difference is 3.3. I'm expecting the difference is going to increase, right? Because it is $3. We have seen it was 6, 7, 8, $10 also. So if I'm feeling that the price difference will go up, how do I execute this trade? Take out Brent oil. This is the one which is expensive, $74. WTI, this is $70.6. The one which is expensive is here. The one which is cheaper is here. If I'm expecting this price gap will increase, the expensive should go up, the cheaper should come down. This is how the price, the gap will increase. So what I'm doing right now, I'm buying 1,000 barrels of Brent. I'm short selling 1,000 barrels WTI. Buying one, short selling another. Same quantity, because they move in similar direction. So what I'm going to do, I'll confirm a buy, I'll confirm a sell right here. I'm going to close the rest of the trades so that we can focus on this one. Look at this. What is my loss right now? Total loss $277 on 1,000 barrels. 272, 277, 276, 270. See, it's fluctuating right here. I have bought Brent oil. I have short sell WTI. Now tell me one thing. Again, I will repeat myself. I have bought Brent oil. I have short sell WTI. If oil price comes down, which position will be in profit? Please write your answers over here. I am long on Brent, I am short on WTI. If oil price comes down, if overall oil prices were to come down, which position will be in profit? WTI or Brent? Write your answers, guys, write your answers. So you will also know how much you have understood. I will write my answer in my notepad. If oil prices were to drop, both the oils, which position will be in profit? Brent or WTI? I'm long on Brent, I'm short on WTI. And it also, if you see in this position, it's orange for S and blue for B. So which position do you think will be in profit? Brent or WTI? Okay, now the few answers have started coming in. See guys, there's a right answer to it, there's a wrong answer to it. But try it out. If you don't try, you will never learn, you will never understand. Or ask me, and I'll be able to give you the right explanation as well. But do attempt this. This is really important if you need to understand. Okay, I think a few of you have replied. Good enough. I hope that next time I see a lot of other people also replying on this. But I understand it may not be the most easiest topic to start with, but then somebody has to attempt it, right? If oil prices come down and both the oil prices fall down, because you're short on WTI, you will have a profit in WTI. On the contrary, if oil prices go up, you're buy on Brent, right? You're long on Brent, so you will have a profit in Brent. Now we just noticed. So your question should be, Yogesh, we just saw that both the price they move up or down together. If I'm buying one and short selling another, basically I'm not able to make any profit, because if oil price goes up, I make a loss in WTI and make a profit in Brent. But if oil price comes down, I make a profit in WTI, but I make a loss in Brent. So why I am buying one and short selling two products which move in the same direction? Same reason. Our expectation is that while you are long on one and short on another, they do move in the similar direction. But our expectation is that there will be a point where maybe the one which you have bought will go more higher than the one which you have shorted. So the idea of a pair trade is that you are expected to make a loss on one leg, on one trade, but you're expected to make a higher profit in the other as compared to the loss. This happens all the time in pair trades, which are in two products which are very similar, that you anticipate that both of the products they move in similar direction. So why I'm buying one and short selling another? Because now you are speculating that one will outperform another. It's like two racers who are working really hard, getting the same training, right? So you bet on both. So you know that only one is going to win eventually. Now, the point is the one which you have betted on will run slightly faster than the previous. That is exactly how a pair trade works. Whether it is on Pepsi and Coca Cola, Brent and WTI, or any two related products, MasterCard or Visa, you buy one, you short sell another because you anticipate that one is going to outperform another. They're very similar to each other, but your trade is based on the idea that one is going to outperform another. And that can be due to various reasons, right? Today, if you have bought Brent and sold WTI, if there is a for example, if the war between Israel and Palestine goes worse and more countries get involved into it, which could reduce the supply of European oil, then Brent prices might go up more than WTI. So the gap increases, right? So the spread increases. So right now, if you have bought 1,000 barrels, then the price difference is three. If this becomes six, you're making $3 per barrel. That's $3,000 profit. So, and let me tell you also, somebody has asked that what is the duration of this trade? The duration of this trade could be 10 to 14 days, because the price difference does not move like $1 every day. No. Sometimes you might see 5 or 6 days, your trade is just like this. Your loss is still 277, 271. So if you see as we speak right now, our loss is still 266, 265, right? While oil is moving continuously, but as you can see that your loss is still same. It's locked, kind of locked. It will only increase if the one which you have bought is coming down and the one which you have short sell is going up. That is where your loss will increase, right? But mostly the products which are so similar, you speculate or you bet on one outperforming another. This is how market neutral strategies work, right? Same works with gold, silver, right? Two precious metals. The price, this chart which you see right now, this chart is not the chart of gold prices or silver prices. This is the price of gold price divided by silver, what is called as gold silver ratio. You will be amazed to know that a lot of traders, they don't take trades in gold or silver separately. They see that if the ratio of gold and silver prices has reached to a point, has reached to a height from where this ratio might go higher, so which means the numerator, which is gold, might go up and silver, which is the denominator, might come down. So they buy gold and short sell silver equal value, expecting to make money on the ratio and not on the actual prices. Gold silver ratio, guys, has it has one of the most uh, popular, uh, I should say, one of the most popular volumes, because when markets are uncertain, when we don't know today, do you know that whether gold price is going to go up or silver prices are going to go up or come down? We don't really know that. I mean, we always predict, we always try to do our analysis. What if there was a way to speculate on this trade but with lower risk? That is what gold silver ratio is, right? You definitely, any strategy you do put a stop loss, because you need to keep that, okay, what if this strategy does not go in my favor? That goes without saying, guys. This is a standard disclaimer that any strategy I'm telling you right now, it's not risk free. It has their risk. Obviously, the strategies are done to lower down that risk. You can never eliminate the risk completely. There will always be a certain amount of risk, if not market specific, then security specific. So here we have tried to reduce the market specific risk, overall market specific risk, and we have brought it down to two products: gold and silver, Brent and WTI, Pepsi and Coca-Cola, or MasterCard and Visa, right? We have reduced the overall risk, but we are trying to again understand this. So there is a way you can take a trade in gold silver ratio also. Now, before I end this session, I will give you two strategies which we had actively worked on. And one of them was a pair trade between Japan and South Africa, which would show you here. To share my screen right here. Okay. Concept was very simple. Japan, uh, which was performing well. I mean, all of us know that in Japan markets came down, but then it recovered also. What we compared, we brought two economies together, Japan and South Africa. Strategy was to go long on Japan and short sell South Africa, right? In derivatives, when you short sell something, the brokers incentivize you and gives you a sort of income when you short sell something some of the times. And on South Africa, currently, if you short sell, you would be receiving a holding cost of around 6.2%. This was last what we understood. Again, to know more about holding cost and swaps, how this works, we can have a session. But to give you a broader perspective, let's just understand right here how Japan and South Africa have individually performed, right? And then we'll understand that how, if you bought Japan and short sell South Africa and included the holding cost factor, the swaps which you receive, how this strategy would work out. So these were the individual performances of Japanese index from 2014 till 2023. This were the individual performance right here of South Africa, right? Individual performances right here. And then if you bought Japan and short sell South Africa, this would be the return right here. But so here you will see a lot of reds, right? If you have implemented this strategy. But the moment the holding cost factor comes, where if you're short sell, you receive interest, and if you buy, you pay, you see most of the times net, you have received that amount. And that's where the strategy becomes more beneficial, right? So total return, including the swaps. A lot of brokers are swap free. So when you're receiving swaps, you do not get it because it's swap free. And that's where we draw a line and we tell you that there are strategies where you can receive net swaps in your account and you can make a strategy out of it. But more than this should be seen as a pair trade. And sometimes, why would you buy Japan as an index? Even if you forget about the holding cost factor, we recommended to buy Japan because, again, the stock markets in Japan have started increasing. The post-pandemic reopening of the Japanese economy was better than expected. A lot of foreign investments were happening in Japanese equity market. Governments were incentivizing for investing more in Japanese stocks, right? So the economic outlook was more positive. In case of South Africa, there were frequent power cuts. Um, the inflation was still high. GDP forecast was low. So we short sell South Africa. So these kind of pairs also work while your other trading strategies are already happening. See, guys, you have to understand that these strategies is not something you put all your savings in. This is just another way to diversify. Just try to reduce the market risk. Imagine if you had only bought Japan or only short sell South Africa, you are exposed to a risk. But if you buy Japan and short sell South Africa, equal value, now your risk is connected to these two economies. And most likely, if the markets fall, like Japan falls, South Africa also falls. So maybe you're making a loss in Japan, maybe you're making a bigger profit in South Africa because South Africa has fallen more than Japan. This is how pair trading works, right? Similar strategy which we did between Japan and South Africa, we did with Switzerland, South Africa, because South Africa has constantly underperformed a lot of indexes, including Nasdaq. It did underperform Switzerland also. It did underperform Japan also. South Africa have been troubling a lot. So how you take advantage these strategies, like the examples which I'm giving to you, some of them have been done this year, some of them have been made previous year but are still applicable. But obviously, as I said, this is only for information purposes. You want to learn more about these strategies, you come sit with us and we'll make you understand that how these things work. I absolutely understand that this is a complicated topic. It's not something which you understand in one go, but this is my attempt to make you aware about a different form of investments which is going on. This is something which is done by hedge funds, and a lot of people are not really aware about that this happens, right? So as it is one of the informative sessions, so it was my duty to bring you something really different and something new. So these are the strategies which work, guys, and I'll be more than happy to sit with you and help you out in understanding more of this. Market neutral strategies can happen between gold and silver, Brent and WTI, a small cap index versus the German index, right? And there are so many ways. Even imagine in the bond market, if you're a bond investor, if you invest in bonds, uh, the when the notion was that the rate cuts are going to happen, you could buy a 30-year bond which is more sensitive to interest rates as compared to a 10-year bond. So you would buy a 30-year US bond and you will short sell a 10-year bond, expecting that the price of 30-year bond will jump if a rate cut happens and 10-year bond will remain the same. So you can make a pair out of that also. These pair trades require constant updation, and it's not something which you search on Google and do it. So over here, we are connected to a lot of research parties. We have our own research department, so we continue to monitor and track the movement in these pairs, and that's how we create these strategies and sit with the clients and make them understand. So any client from retail to high net worth individuals to ultra high net worth individuals can do these strategies, but obviously risk is employed, and we want to sit with you and make you aware about this form of investment as well. So, guys, if you like this session, please review us on Google, Century Financial. Please do drop a review. This really helps us and motivate us to do more and more sessions like this. Tomorrow we are going to do one more session. As I said, this is September. Every single day there is going to be a webinar 7 to 8 p.m. Today was on market neutral strategy. Tomorrow it's going to be happening on a different topic. And we want to make sure that these webinars reach out to you. So the recording of these sessions will be available as well. And every session we are going to do, there is going to be a recording, and you can always visit our page and definitely go through every single recording which we are going to put over there. So tomorrow we are going to learn more about understanding economic events, fundamental analysis, how fundamental analysis work. When you are looking at a stock, what you should see, which economic events are important, non-farm payroll, central bank decisions, and all of these. So as a fundamental investor, it will really help you to plan your trades and plan your investments as well. And we are going to learn about the importance of non-farm payroll data, unemployment rate, GDP numbers, what is coming next, impact of US elections, and impact of elections on your investments and how it works, right? So thank you so much for your time today, guys. I know this was one of the most complicated topics, and I'm not really sure that how easy I made it for you. But just a few questions over here, that can we get access to these kind of strategies as well? Definitely. Just call your relationship managers and ask for these PDFs. I'll definitely download and put this presentation for you to view, and definitely. Some of you have inquired about a one-on-one session, guys. This can happen anytime you require, just not 7 to 8, because every day I'm doing a live 7 to 8 session for our attendees. But if you want to connect tomorrow, first half, or day after tomorrow, or after that, I'm definitely available in the first half, and we can learn more about what we have discussed today, and I can do a review for you, and also show you the live platform and how to implement these strategies and discuss much more further, right? These are introductory sessions. You want to know more, let's have a cup of coffee, sit and understand about this, right? So thank you so much, guys. I'll see you tomorrow 7 to 8 p.m. once again, about talking about fundamental analysis and economic events. And it's going to be again one of the very interesting sessions, and after that we'll have more and more sessions coming in. So this entire month is planned with a detailed itinerary of what sort of sessions we are going to have. Visit century.ae and go to learn webinars section, and you will find ultimate webinars menu. Click on the schedule and you will be able to see that what sort of webinars are coming up. To Some of you have asked that if I want to attend all the webinars, do I need to register separately? Yes, you have to register separately for every webinar you need to attend. So if you have done a session today, you want to register for tomorrow, you have to go for and do it separately. So please go to our page and find out. And definitely, I would love to see all of you. A lot of names which I saw on day one are still here on day three. So it's a really good start, and I hope that till day 21 we kind of form a habit of attending these webinars. So you have a good night. Thank you so much for taking out time. And my name is Yogesh. I'll see you soon tomorrow, 7 to 8 p.m. once again.